Good morning, everyone. Today is June 10th, 2020, and we're going to do our weekly strategy call. This is obviously an internal call for Zacks professional services staff, and we have a new release coming out this evening, a new build on staging that I'm showing right now that'll actually go into production this evening, illustrating the new equity model portfolios, the Admiral portfolio that was announced last week. And again, this is the smaller 30 stock earnings certain portfolio that has the same growth characteristics and all the same underlying performance characteristics as the larger earnings certain portfolio, just in a smaller portfolio size. For those that are managing smaller portfolios or finding it cost prohibitive to perhaps manage a 75 stock core equity portfolio, this is ideal for those individuals. The tilts portfolio is also going to be available tonight, and that's the 6 tilts that I recommended back in March who've been performing absolutely spectacularly. We're going to look at that in a minute. We are going to have another drop of advisor tools sometime in the next couple of weeks. We are going to be rolling out the new Dividend Aristocrat portfolio, the earnings certain Dividend Aristocrat portfolio. Today, I'll be talking about it a little bit later on in the strategy call, so please stay tuned. Wanted to just mention briefly the performance of the tilts. And again, these are the tilts that were recommended back in March. This is a tilt strategy that I've been running personally for many years, and it continues to pay off dearly. Every time we see a value rotation, it might last for a day or two, maybe even 3, and then as we've seen in the last 2 days, this leadership group from the S&P 500 just tends to take hold, and again today, as we saw yesterday, with the markets down, this group continues to dominate. And again, I always recommend the addition of Adobe systems. Again, nothing happens on the internet without Adobe. And so a tilt position of these 6 stocks in conjunction with any of the earnings certain portfolios that we maintain are kind of ideal right now for this environment. One of the earnings certain stocks is in the news, and it's Campbell Soup. And so what I'd like to do is hop into the institutional platform and just take a look at some of the valuation drivers behind Campbell. Campbell has been on watch over the last several years, on and off. It did struggle with revenue growth, and you can see what happened here. A lot of cost-cutting initiatives, a pretty sizable earnings decline, pretty sizable decline in price. Still an earnings certain portfolio member. It does have great earnings stability overall. It does go through these cycles about once a decade or so, and I put it on watch just to ensure that we can see stability in the business. As of late, Campbell Soup has been kind of plagued with supply chain issues and being able to keep up with demand for inventory during the COVID pandemic. And the article that I circulated this morning, kind of talks about that. They've also made some changes in their forecast for revenue growth, and the CEO has been promising not to basically miss out on the ability to continue to deliver on growth given the latest demand for Campbell's products. And so, when I see revenue growth of 6%, I see earnings, here forecast earnings growth of like 8.2% in ZRS. This is coming from the sell side. The article that I circulated before to everyone here, this is where they're actually giving revenue guidance of 6%. And whenever I see that kind of disparity, I always tend to look towards margins. So we're gonna really kind of hone in on margins here. But before we do that, what we really need to do is take a look at the buy side bid to valuation currently. And for that, I like to put the model into default mode just to make sure that it's in default mode. And again, this is the valuation model in the Zacks Research System. And it's basically showing that if the buy side were to actually pay the fully vetted sell side growth valuation of 8.28%, we'd be looking at appreciation potential of like 33%. And so the buy side is obviously seeing something in here where they're not willing to pay a full 8% growth, which makes sense because the company's just come out and basically guided to 6%. And so the neat thing we can do, and again, last week we spoke of this concept called normalized earnings. And you can see that with regard to the fulcrum point on F12M here and the forecast growth trend seems to be fairly in line with estimates. So we can pretty much call this normalized earnings. But what we need to do is we need to taper down this growth assumption, because in order to get the market implied growth rate out of the model, we need to get the current model return. Instead of 33%, we need to get that equal to 0. And so to do that, I'm just going to click on this arrow tool, and I'm just going to change the slope of that growth rate. Keep in mind that, you know, if we were to be valued at a full 8.28%, I could run this back up to where it was at about 33%. Should be about right there. We would have to have a model PE of 23, and right now we're trading at a forward multiple of 17. And I can see throughout history, we have actually traded at 33 multiples or perhaps even more. I can see it back here in 98 as well. I don't need to pull up a PE chart to verify that. I can tell by the distance between these two lines that it's been attained. Obviously, equity risk premium a little bit different in those environments. That's kind of the other half to the PE multiple expansion or contraction argument. We don't need to explore that today. We'll hit that in a future session again, just as a wrap up, as a refresher. But what it is important to note here is that we are only trading at a 17 multiple. So in order to basically back into how the buy side is actually valuing, or what I like to call the bid to valuation for Campbell, I just ratchet this growth rate down. You can see as I'm doing this, the model PE begins to approach the actual PE. The model price begins to approach the actual price. And we end up with a current model return that continues to hit or approach 0 until we get it right at 0. And you can see that we're literally sitting at negative 0.01. I can click on the market implied growth rate. It'll actually snap it to 0. And you can see that the buy side is currently paying about 5% growth for Campbell Soup, which may make sense, right? I mean, I can see FY3 estimate out here at 5% growth. We know that they just guided to 6%. That's only over the next year. So the idea here is we need to look at the sustainability and supportability of this market implied growth rate. And I think that when you look at the growth and margin check for Campbell Soup, you'll see where they've really worked through their troubles here, specifically in 2018. And then this most recent period, which is the April 20 quarter that management got super excited about and actually changed their guidance now to 6% growth. Basically for the rest of for the next year. So I mean, this is really, really good news. And the idea here is you can see where again they work through their troubles. Whenever I see this type of information, I want to actually look towards some of these margin trends and specifically look at some margin charts. But to do that, I like to just grab a custom chart that I created called Zacks Margin Analysis Absolute. It comes as a default view in the Zacks Quick Analysis. It's one of the go-to charts that I use in my analysis all the time. And you can obviously see that precipitous decline in revenues. They did a ton of reorging. They cut the number of SKUs. Gross margins and everything skyrocketed at that point. They really had trouble with earnings growth, and then all of a sudden now we're sitting at the bottom of a margin cycle. So, even more so the fact that management has guided towards 6% revenue growth, which is great. The real opportunity here is perhaps the fact that we're sitting at all-time low margins. And, any sort of uptick in, gross margins and operating margins is going to lead to perhaps a parabolic expansion in the net margin, which would just be great to see. So that's kind of what I've got my eye on here for Campbell Soup. Again, it's been an earnings certain portfolio member pretty much since the inception of the portfolio. It's got a great dividend. It's actually also part of the Admiral portfolio, and it's also part of the new Dividend Aristocrat portfolio that we'll discuss here in a little bit. So just a quick and dirty 3-minute or less analysis using the Zacks Research System. Again, it appears as though, it may be fairly priced, maybe a little bit room to run, depending upon what happens with these margins. If we can actually get the margin improvement on input costs and operating margins continue to improve, that this could be a real opportunity for a turn in net. So we'll keep an eye on it, as we always do. Next thing I want to turn our attention to is what's going on with the tech stocks. And I already spoke a little bit about the tilts and what's been happening with the tilts. Again, that has just been absolutely spectacular leadership. As a matter of fact, in this week's Wall Street Journal, this was actually Monday, June 8th, right in the business and finance section, they have a new flavor, a new twist, if you will, on something that I brought to everyone's attention in the first earnings certain portfolio call, or that maybe even the tilt call that I did back in March, where I spoke about the fact that the top 5 names in the S&P happen to equal the weight of the bottom 355 names in terms of market cap weight in the S&P 500. This is a little bit different skin on the technology stock argument. And keep in mind, we've got Alphabet and Facebook. They are tech stocks, but again, these guys are in the telecom sector because they're more advertising companies, but we still call them tech stocks. And obviously Adobe's not up here as another tilt, but all 5 of these are 5 of our 6 tilts. And the reason, again, for that is because we all know, especially now, since if you read the article, combined weighting of the S&P's 5 largest companies doubled since 2013. I mean, you're talking 20% of the weight of the S&P 500, and this is the leadership group of the S&P 500, is within these 5 names. Okay, that's almost double from the end of 2013. And notice, the energy sector just keeps shrinking. I mean, here's ExxonMobil been totally squeezed out of the top 5. I remember when the big story was, the battle between number 1 and number 2 between Apple and Exxon. It didn't take long for that to play out. Berkshire Hathaway has been knocked down, and you can see that the top 5 names are just continuing to dominate that proxy. So this is huge. So I went back to a spreadsheet that I look at from time to time, and this is one that I presented back in the Tilt webinar. It's obviously one of the drivers to the Tilt recommendation is just looking at this pure dominance and some of the returns that are coming out of these top names. And you can see why the S&P has literally been led by this group, especially post-pandemic. So if we look at price changes of the top 5 names in the S&P 500, and again, this is literally a spreadsheet that one of my analysts here, Jeff Wickman, produced for me and maintains for me. And he's also a salesperson. We look at this post-pandemic period from 220 to 69. So this is literally as of yesterday's close. And you can see that Amazon is up 20%. You've got Facebook up 11%. Everything pretty much in positive territory, and Google sitting pretty well, flat, if you will, down just in 4%. You can see that those bottom 355 names, they're still sitting almost even with the top 5. So the bottom really hasn't made much headwind against the performance of the top. And that's what I kind of like to take a look at. I always like to scroll down to the bottom of the list too, to just see if any of these names down here are turning positive. These are your smaller cap names in the S&P 500. We know that small caps have done reasonably well as of late, but the idea is, is this value rotation kind of enough to dethrone this leadership group? And, I've always said, to stick with growth. And even if you're going to do a tilt into small caps, you still want to keep a real eye on the growth and growth drivers, specifically the S&P small cap growth tilt. So as I pan this list, and again, I just went down to the very bottom 500, I can still see just a complete sea of red. Obviously, nowhere near as bad as the 50, 60, 70, 80% declines that we saw back in March, but it's still pretty rough, relative to how the top names are doing. So not much of a change is what I'm saying. And again, that just goes back to the argument that this group of 5 names plus Adobe, and I continue to see that as a solid leadership group. So speaking of some of the small cap names, this is something that I keep hearing about every day. I read about it, and I see a lot of tidbits about small cap in general, down but not out in the case of this article. What I want everybody to understand is that small cap value and small cap growth are very, very different, not just by nature of the style itself, but in their exposure to sectors. So I thought this was really good to share with the team, only because it explicitly states that it's dominated by finance companies. And that's what I really want you to take away from small cap value. Small cap value is dominated by small financial companies, and we all know how we feel about small financial companies. There is a time and a place for financial companies. It just doesn't belong in a core portfolio, for the reasons that we've talked about in the initial strategy call that's still available out on YouTube. It also obviously includes many other sectors, and they list them out here, but the predominant one that I want everybody to think of, whenever you hear small cap value, I want you to think small financial companies. And then the flip side to that is whenever we hear small cap growth, I want everybody to think healthcare. Okay? Now, we all know that healthcare, consumer staples, and consumer discretionary, those were your leadership sectors into the pandemic, right? So if I was going to bet on small caps as a tilt, and I'm a little bit nervous that there might be a resurgence here in COVID come the fall, would I want to expose myself to small cap value, which we know has a primary tilt towards financial companies, and we know how financials led the decline of the S&P 500 into the recession? Or would we want to expose ourselves to small cap growth, not just to have, because we know growth really never goes out of style, not just to have exposure to the growth tilt itself, but we also really would rather be exposed to healthcare names versus financial companies if we're going to have a retest of any sort of, states being closed down because of a resurgence of coronavirus. So again, really important to not take these style groupings at face value, but to know where your exposures really are is really key. Okay. The next thing I want to talk about is the earnings certain portfolio that we're rolling out today, called the Earnings Certain Dividend Aristocrat. And I have several views that I want to show, and I guess I'll just go right to the valuation model. It's probably the easiest place to start. Again, we're doing this live, unscripted, so bear with me as we're actually navigating the product in real time. If you look at the earnings certain portfolio itself, in core, it's 75 names. Last week, we rolled out the Admiral portfolio. And so let's just do a quick review of the earnings certain portfolio, look at some of its characteristics again for everybody. And again, the idea here is the 75 stocks whose underlying, dollar weighted, equal dollar weighted average corporate earnings can go through recessions virtually unscathed. And you can see that we do have a little bit of a dip here with the earnings certain names. As I mentioned in my strategy call last week, that this was kind of the ideal litmus test, if you will, something that I'd been working on for 5 years prior. And now that we've actually got companies reporting, we're able to go in and actually see who is able to get through this recession. And that's how the Admiral portfolio was finally solidified after 5 years of working on it. You can see as I pull it up, that earnings line actually gets just a little bit smoother. So even more earnings stable and small 30 stock membership versus 75. Notice the dividend yield, the beta is lower. Notice that the growth characteristics are virtually the same. Least squares growth 11.48 on consensus estimate of long-term growth rate estimate of 8.5. If I go to the core portfolio, which is earnings certain 75 stock member, it's 8.6. Similar long-term growth trend as well. So again, with the core portfolio of 75 names, I expect those earnings to snap right back to earnings certainty. This just kind of being a one-time notch. You can see that long-term least squares trend growth rates really not impacted at all. So kind of a non-recurring one-time event, as I mentioned last week. When we look at the Dividend Aristocrat portfolio, what we're looking at is 25 names of your higher yielding dividend paying stocks in the earnings certain portfolio. So you've still got earnings certainty. You've got a yield that is effectively better than Noble. I think if you look at the actual Noble ETF, I think it's paying about a 2.2 indicated yield. And I think this one's sitting anywhere between like a 2.8 and 3%, depending upon the price actions. It can be anything like that. But this is showing about 2.8 right now. Performance is spectacular. And if you compare the growth of the portfolio, so the earnings certain, the Dividend Aristocrat portfolio, least squares trend rate, 8.5. We've got a consensus growth rate for long-term earnings growth at 7.32. If you compare that to the S&P 500, okay, first of all, you obviously lose a lot of yield, 1.89. You can see that earnings variability that we don't want our clients' portfolio being subject to, but also from a least squares trend growth perspective, lower at 6.3. So even the Dividend Aristocrat portfolio is going to be a better alternative than the S&P 500 in many regards. Lower systematic risk with lower beta. But specifically now when we look at Noble, which is the S&P 500 Dividend Aristocrat group, this is where you're going to get, again, exposure to those tilt sectors that you don't necessarily want in your client portfolio. Not only is the dividend itself at risk, but in many cases with the energy names and some of the financial companies with suspensions and dividend cuts going on, but you've also got long-term least squares trend rates sitting at 7.75, and roughly the same amount of growth in terms of consensus forecast. So the idea is you can basically mimic the S&P 500 Dividend Aristocrats ETF. You can call it your own. A. B. You can eliminate the earnings troughs in these recessionary periods. And when you look at performance, it actually translates quite well in terms of performance. So if we look at this from the perspective of let's just do a pandemic period, so 220 to 6.8, and we bring in the Dividend Aristocrats. I mean, you can see, again, as expected, because of those tilt sector, that energy and financial exposure in Noble, the earnings certain Dividend Aristocrat portfolio just holding up so much better, smaller standard deviation, lower standard deviation in returns, and just better performance in general. So the earnings certain Dividend Aristocrat portfolio, even though it's not going to be in the build of advisor tools under equity model portfolios that comes out tonight, it will be in the next release. We can make this available to our clients and prospects. I will email the model out to everyone today so that if someone is interested in the earnings certain Dividend Aristocrat portfolio of 25 names, you can email that to them. Again, it will be in here as an equity model portfolio in the next release. So we've got the earnings certain portfolio, that's the 75 names. That is managed to a 75 stock portfolio. The earnings certain Admiral portfolio is a 30 stock portfolio. It's not going to be held necessarily at 30 stocks. It's going to be somewhere between 20 to 30 names at all times. And same thing with the Dividend Aristocrat portfolio. I'm not going to hold that necessarily to 25 names. It could go up a little bit. It could come down, depending upon what happens with the underlying companies. So that's it for today, and those are the thoughts I'd like to leave everyone with for this week. Thanks, everyone.